When we talk about the world of electric vehicles, EVs, and the future of energy, are you overlooking the world's largest company in the space? CATL, Contemporary Amperex Technology, isn't just a battery maker. It dominates nearly 40% of the global market, partners with giants like Tesla and BMW. But in an era where the US maintains strict measures and the market is, well, volatile, does CATL still offer high growth potential, or is it facing some serious valuation pressure? Today, we're diving deep into this game changer of the EV industry. Hello and welcome to Inside AI Brief Set Hang Seng. Before we dive in, please remember to like, share, and subscribe. So, CATL. It's hard to overstate their importance, right? Almost 40% global market share in EV batteries, #1 in energy storage too. But market leadership doesn't always equal smooth sailing, especially now. You've got geopolitics, commodity prices all over the place, regulations. So that's our mission today. We're diving deep, evaluating the fundamentals. Does CATL's tech and market lead justify the valuation? Or are the global headwinds just too strong, even for them?
Yeah, that's the core question. And we've got some solid sources to work with here. We're leaning heavily on CATL's own H1 2025 interim results. That's the freshest official data. And we're mixing that with current market intel, like lithium prices, right up to October 2025. So we can really see how the real-world inputs are affecting them.
Okay, good. So how are we breaking this down for everyone?
We've laid out 5 key areas to look at. First, their market power. How dominant are they really, and where's the growth coming from? EV versus energy storage. Second, financials. Why is profit growing so much faster than revenue? That's interesting.
Definitely.
Third, their expansion plans. Think globalization, new tech. Fourth, the risks, raw materials, geopolitics, all that stuff.
Right, the unavoidable headwinds.
Exactly. And finally, we'll pull it all together. What's the overall picture for you, the potential investor?
Perfect. Let's jump into segment 1 then. Market dominance. The sheer scale.
Right. The scale is, well, it's massive, like you said, almost 40% globally for EV batteries. The specific number from S&E Research, January to May 2025, was 38.1%. And what's really telling is they actually grew that share slightly year on year by 0.6 points in this market. That's quite something.
Holding ground and even gaining a bit.
Yeah. And crucially, they're also #1 globally in producing batteries for energy storage systems, ESS. That held true for the first half of 2025. So leadership in both mobility and stationary power.
Yeah.
It's quite unique.
Okay, let's focus on the main engine first. EV batteries. That's the bulk of the revenue.
Oh yeah, by far. In H1 2025, EV battery systems brought in about RMB 131.6 billion. That's almost 74% of their total revenue.
And it grew.
It did. Solid growth, 16.8% year over year. So still a primary driver, no question.
But wait a second. You mentioned earlier the overall market for EV batteries grew much faster.
That's the interesting context, yeah. Global new energy vehicle sales, NEVs, they jumped 32.4% in that Jan-May period. And global EV battery usage grew even faster, 38.5% year over year, hitting over 400 GWh.
So, hang on. Global usage up 38.5%, but CATL's EV revenue up only 16.8%. Why the gap? Are they losing share in real terms, or is it pricing? What's going on there?
It's likely a combination of things. First, you've got the base effect. They're already so huge, it's harder to post massive percentage gains year after year.
Sure, law of large numbers.
Right. Second, and probably more significant, is pricing pressure, especially in China, their home market. Competition there is absolutely fierce. Think BYD pushing hard. So CATL might be choosing to focus more on, say, higher margin deals or specific strategic partnerships rather than just chasing volume at any cost.
That makes sense. Protect the profitability.
And speaking of partnerships, their customer list is basically a who's who of global auto. Volkswagen, BMW, Volvo, Stellantis, Toyota, Nissan, even newer players like Xiaomi and NIO.
So they're diversified across many big clients. That's a good buffer.
Definitely. It spreads the risk. If one automaker has a slow quarter, it doesn't sink CATL's whole EV segment.
Okay, let's switch gears to the other engine. Energy storage systems, ESS. This is supposed to be the next big thing, right? For grids, renewables.
Absolutely critical, strategically. You simply can't run a grid reliably on wind and solar without massive amounts of storage. It's fundamental to the energy transition.
So how are the numbers looking there?
Well, this is where it gets a bit complex. ESS revenue in H1 2025 was RMB 28.4 billion, about 16% of their total. But, and this was surprising, the revenue actually declined slightly year over year down 1.47%.
Down. But isn't the global ESS market exploding? That seems counterintuitive for the market leader.
Exactly. The global market is absolutely booming. Data from Motion shows global BES, battery energy storage systems, installations hit almost 87 GWh in the first half of 2025. That's a huge 54% increase year over year.
Wow, 54% growth globally.
And the driver is clear, especially in China. Their new wind and solar installations more than doubled, up 105% year over year. All that intermittent power needs storage.
Okay, so 54% global growth, but CATL's ESS revenue shrinks by 1.5%. How do we square that? Is that a red flag? Are they losing ground, or is it just noise?
It's a really important point to dig into. It's probably not a single factor. First, think about project timing. These utility-scale ESS projects are massive. Revenue recognition can be lumpy. A delay in finalizing a couple of big contracts could easily skew a half-year result, even if their order book is actually strong.
Ah, okay, so timing could play a big part.
Could do. Second, price wars again. The ESS market, particularly in China, is known for really cutthroat competition. Lots of players trying to win those big government-backed grid projects. CATL might have strategically shifted focus, maybe prioritizing higher-margin international deals, or perhaps focusing on launching their newer, higher-capacity products like Tenor. That could cause a temporary dip in reported revenue even as the overall market booms.
So maybe a strategic choice, not necessarily losing the race.
Possibly. And strategically, ESS is still vital for them long-term. It's about powering the grid transition, which is a decades-long trend.
Okay, that makes sense. Let's move to the financials then, segment 2. This is where things look, well, pretty impressive despite some of that segment nuance.
Yeah, the H1 2025 numbers really stand out against the market backdrop. Total revenue, RMB, 178.9 billion, up a modest 7.27%. Okay, fine. But the profit attributable to owners, that jumped 33.02% year over year, hit RMB 30.5 billion.
Right, that's the number. 7% revenue growth driving 33% profit growth. That's not just market lift, that's efficiency.
Exactly. It signals really strong control over costs, or maybe a shift in their product mix towards more profitable stuff, or perhaps that supply chain advantage kicking in.
And earnings per share followed suit.
Mirrored it. Basic EPS up 32.82% to RMB 6.92 per share. It shows the profit growth is flowing through.
So the key must be in the margins. Did the overall gross profit margin improve?
Significantly. It jumped to 25.02%, up from 23.45% the year before. That's a gain of over 1.5 percentage points. Pretty healthy.
Okay, but where did that margin improvement come from if EV batteries face pressure?
Right. You have to break it down. And you're spot on. The core EV business didn't drive the margin gain. EV battery GPM actually dipped slightly, from 23.48% down to 22.41%.
Okay, so EV margins down a bit. What about ESS?
ESS margins did improve, but only slightly. Went from 24.41% up to 25.52%. So a small positive contribution, but not the main story.
So if it wasn't EVs, and only a little bit from ESS, what drove that overall jump to 25% GPM? This must be the aha moment.
This is the aha moment. The star performer, the thing that really insulated them, was their vertical integration, specifically battery materials and recycling. The gross profit margin there just exploded. It went from 8.21% in H1 2024 all the way up to 26.42% in H1 2025.
Wow. Wait, from 8% to over 26% in 1 year.
Incredible, isn't it? More than tripled the profitability of that segment.
That's huge. So they basically turned recycling and materials, which you might think of as a cost center or low margin necessity, into a major profit engine.
Precisely. It shows incredible operational skill. When raw material prices like lithium are bouncing around, CATL has this internal hedge. They're making strong profits from processing the very materials that are a cost headache for competitors, relying solely on external suppliers.
Controlling the life cycle, not just selling the box.
Exactly. And their standalone battery materials segment also saw improved margins, from about 7.8% to 9.1%. It all points to deep control over the value chain.
Okay, that explains the profit acceleration. What about their balance sheet strength? They need cash for all this expansion, right? Liquidity looks good.
Very strong. Net cash from operations grew over 31%, reaching almost RMB 59 billion in a half year.
And debt levels?
Actually improving. Their gearing ratio, basically debt relative to equity, dropped from about 65.2% down to 62.6%. Lower is generally better, means less reliance on debt.
And that big H-share listing in Hong Kong must have helped there.
Absolutely. That brought in a huge chunk of equity capital, significantly improving the gearing.
Which brings us to the cash pile. How much are they sitting on?
It's pretty staggering. As of June 30, 2025, cash and cash equivalents stood at RMB 323.8 billion.
323 billion RMB. That's an enormous war chest.
It really is.
Now, is that too much cash? In a growth industry, you want to deploy capital, right? Could that huge pile be seen as inefficient, sitting there not working hard enough?
That's a fair question. And usually, yeah, investors might frown on excessive cash, but you have to look at CATL's specific situation. Their expansion plans, like the Hungary project we'll get to, involve massive multi-year investments. They're lumpy, politically sensitive. Having that huge cash buffer gives them immense flexibility. It means they can fund these huge projects without being totally dependent on hitting quarterly cash flow targets or tapping volatile debt markets at the wrong time. It's also a kind of geopolitical insurance policy.
Okay, so the scale of their ambition requires a scale of cash reserves. Makes sense. And, quickly, shareholder actions. Any buybacks?
Yes, they have an A-share buyback program, RMB 4 to 8 billion mandate. In H1 2025, they used about RMB 1.55 billion to repurchase around 6.6 million shares. And interestingly, those shares are earmarked for future employee equity incentives. So management showing confidence and aligning employee interests.
Good signals. Okay, let's move to segment 3. Expansion and technology. They have the money. Where's it going? Clearly global with that Hong Kong listing.
Definitely. That 8-share listing in May 2025 raised a net HK $40.6 billion. And the stated goal was explicitly to build an overseas capital platform, accelerate globalization.
It's a smart move, gives them access to international investors, different regulatory environment.
And mitigates risk. But the key is where that money is targeted. The document showed 90% of those net proceeds, about HK, $36.6 billion, is specifically for the construction and working capital of the massive Hungary project.
Hungary. Why Hungary? Why such a huge bet there?
Location, location, location. Hungary is right in the heart of Europe's booming EV manufacturing scene. You've got the big German automakers VW, BMW, Mercedes all setting up or expanding EV production there.
So CATL is planting a giant battery factory right next door to its biggest European customers.
Exactly. That HK, $36.6 billion, is a multi-year commitment expected to be used by 2030. It's about securing their role as the go-to local supplier for those giants. It cuts down on shipping risks, logistics costs, potential tariffs.
Makes strategic sense. Are they expanding elsewhere too?
Yep. The sources also mentioned a joint venture with Stellantis in Spain, another major European player. And there's the big Indonesia battery industry chain project.
Indonesia makes sense for raw materials, nickel especially.
Right. So it shows a pattern. Secure raw materials in places like Indonesia, build massive manufacturing hubs close to customers in Europe. It's a truly global footprint strategy.
And underpinning all this expansion has to be technology, right? They can't just win on scale alone.
Absolutely not. They talk about their 4 innovative systems framework covering electrochemistry, battery structure, green manufacturing, and even business models. But let's look at concrete products. The big headline grabber is probably the 2nd-gen Shengsing supercharged battery. They're calling it the world's first LFP battery. That's lithium iron phosphate that combines an 800-kilometer range with a peak 12C supercharged speed.
Okay, 800-kilometer range is great, but 12C charging, break that down for us. C rate is charge speed, right?
Right. 1C means a full charge in roughly an hour. So 12C is incredibly fast. We're talking potentially adding hundreds of kilometers of range in just 10-15 minutes.
And why is doing that with LFP chemistry such a big deal?
Because LFP's traditional weakness was charging speed, especially in the cold. LFP is cheaper, safer, lasts longer than the high-nickel NMC chemistries. That's why Tesla uses it in standard range models. But people worried about slow charging. If CATL has cracked 12C charging for LFP, they basically eliminate the main reason someone might pay more for an NMC battery. It's potentially game-changing for making fast-charging EVs more affordable.
Cheap, safe, and super fast charging. That's a powerful combination. What about on the energy storage side?
Equally impressive innovation there. They've launched the Tenor energy storage system. One container holds 6.25 milliwatt-hours. That's a lot of energy. And they've announced the new Tenor Stack, which is a 9 milliwatt-hour ultra-large system designed for mass production.
9 megawatt hours in one system. That's huge for grid-scale projects.
Exactly. Remember, that 105% increase in China's wind and solar. You need systems like Tenor to absorb that intermittent power and feed it back smoothly. It's about density and efficiency for utility customers.
So the tech backs up the scale, and they're innovating in business models too. Battery swapping.
Yeah, they have their Choco Swap and QIJI energy swap solutions.
Right.
Plus, they're cooperating strategically with NIO, which is big on swapping, and even Sinopec, the energy giant. It shows they're thinking beyond just selling batteries, towards providing energy services and infrastructure.
And all this ties into their sustainability push. That seems increasingly important.
Very much so. They're highlighting their 10 zero-carbon factories globally, including the one in Germany. That's a strong signal to ESG-conscious customers. And they're actively working down the supply chain, claiming an 11% reduction in the carbon footprint of raw materials compared to 2024. They're trying to sell a whole green ecosystem, not just a battery.
Okay, that's the growth story, but we have to cover the risks. Segment 4, macro headwinds. Let's start with raw materials, specifically lithium. What's the latest there?
Well, as of October 2025, lithium carbonate prices were hovering around CNY 73,500 per ton. That's actually down slightly year over year, about 1.9%. But it's been volatile. There was a peak back in August around CNY 87,000. So prices are holding firmish now, but the volatility is always a risk factor for costs.
And CATL isn't just a buyer of lithium, right? They actually influence the price. You mentioned their Jiangxi mine.
Yeah, that's a fascinating example. That mine apparently accounts for something like 3% of global lithium supply. Not insignificant. Reports suggest that when there was uncertainty about renewing permits for that mine back in August, the lithium price spiked. Then, when news came out that approvals were moving forward, allowing activity to restart, the price reportedly started to slide again.
So their operational status directly impacts global commodity pricing. They're a price maker, not just a price taker.
To some extent, yes. Their scale gives them that influence. But it also means they face direct regulatory risk around things like mining licenses. It cuts both ways.
Okay, what about the bigger geopolitical risks? Trade tensions, US-China relations, potential restrictions?
That's definitely a major factor hovering over them. Operationally, they have significant exposure to the US dollar and the euro because of their overseas business. They actively manage this with hedging strategies, natural hedges, financial derivatives like forwards and swaps, standard practice for a big multinational.
But the political risk is harder to hedge, isn't it? Especially regarding the US market or potential European scrutiny over subsidies.
Much harder. While CATL hasn't been hit with direct U.S. sanctions like some other Chinese tech firms, they operate under a cloud of scrutiny. Questions about state support, fair trade practices. This can impact their ability to win certain deals, particularly government-linked ones or those in sensitive sectors in the West.
And this is where the dual listing comes back in, Shenzhen and Hong Kong.
Exactly. We talked about it facilitating global finance, but it's also a strategic shield. If access to U.S. capital markets becomes difficult, or if political tensions restrict direct investment from China, the Hong Kong listing provides an alternative route. It allows them to tap international capital, potentially insulating the funding for crucial projects like Hungary from purely domestic or US-centric political headwinds.
So it's a financial tool and a geopolitical diversification strategy rolled into one.
Precisely. It signals adherence to international standards, broadens their investor base, it adds resilience.
Okay, one last risk point. Internal financial risk, contingent liabilities, guarantees they provide.
Right. Given their complex structure and ecosystem approach, they do provide guarantees. To outsiders, it was about RMB 4.6 billion as of mid-2025, and significantly more to their own subsidiaries, around RMB 55.3 billion. That's a lot of backing for their network.
Does that expose them unduly?
Well, it's a large number, but this is where that massive cash reserve becomes crucial again. With over RMB 323 billion in cash, they have more than enough liquidity to comfortably cover these potential obligations. It shows they can securely back their extensive network and expansion plans.
Okay, so the risks are real, but they seem to have significant buffers and strategies in place. Let's pull it all together then. Final evaluation. We've seen market dominance, that surprising profit acceleration driven by recycling, huge investment in global expansion, particularly Europe, and cutting-edge tech like that fast-charging LFP. So back to the core question. Does this justify the outlook? Is CATL positioned to keep growing strongly despite the volatility and the valuation concerns?
Based on these H1 2025 results, I think the case is pretty compelling. Yes, EV revenue growth moderated, but that 33% profit jump is the key indicator. It shows they aren't just riding the market wave. They're actively improving efficiency and profitability, largely thanks to that vertical integration and the incredible margin leap in recycling. They've built internal shock absorbers.
And they're deploying capital aggressively where it matters.
Absolutely. That massive commitment to Hungary, funded by the H-share listing, is a clear strategic move to embed themselves with key European customers for the long haul. Their balance sheet, anchored by that huge cash pile, allows them to make these decade-long bets.
And the tech keeps them ahead.
It seems so. The Shaanxi 12C LFP battery tackles a major cost-performance barrier in EVs. The tenor systems position them perfectly for the booming ESS market. When you combine that tech leadership with the strong industry, tailwinds, NEV sales still growing over 30%, ESS capacity up over 50%. ATL looks like it's executing a strategy designed for sustained high-quality growth, even if the path isn't always smooth. The valuation likely reflects this expectation of continued dominance in shaping the industry's future.
Which brings us to that final provocative thought you mentioned, linking back to their sustainability focus, building zero-carbon ecosystems.
Right. They already have 10 zero-carbon factories, including in Europe. They're pushing suppliers to lower emissions. So here's a question for you listening. As global automakers and energy companies face intense pressure to decarbonize their entire supply chains driven by regulations, investors, customers, how quickly will having a genuinely low-carbon battery supplier become non-negotiable? Could CATL's demonstrated commitment to green manufacturing, verifiable through things like zero-carbon factories, become their most powerful competitive advantage in the next 5 years? Shifting the conversation beyond just price and performance to deep, verifiable sustainability.
That's definitely something to think about. It could fundamentally change how supply contracts are awarded.
Well, how was our in-depth look at CATL? We hope the information will be valuable for your investment decisions. If you have any questions or would like us to track a specific stock, let us know. Finally, don't forget to like, share, and subscribe to support our team. Thank you.